day, BMA students. Today, I am going to discuss the part 2 of the module 2, the role of accounting in business. So I'm gonna discuss the balance sheet, cash flow statement, and the accrual accounting. So first, what is a balance sheet? Balance sheet reports on a company's assets, liabilities, and owner's equity at a specific point in time. This reports the following information. Number one, the company's assets. These are resources from which a company expects to gain some future benefit. Its liabilities, the company's debt owed by the business to an outside individual or organization, and its owner's equity, the amount that is invested in a business by its owners and that owners can claim from its assets. Your income statement reveals the revenue earned over a certain period, while your balance sheet provides a snapshot of your assets and liabilities at a specific moment in time. Most firms create financial statements annually, aligning their fiscal year, which is your company's designated business year, with the calendar year ending on December 31st or another date such as June 30 or September 30. But typically, a company selects a fiscal year end that coincides with its peak sales period. For instance, a company dealing with seasonal product might choose a fiscal year end when its sales are at their lowest. In addition to annual reports, many companies also generate financial statements on a quarterly or monthly basis. The frequency of preparing balance sheets can vary depending on companies' needs, regulatory requirements, which is mga sa BIR, and industry practices. Some firms may prepare balance sheets monthly, while others might do so quarterly or annually. It's essential for a company to determine the frequency that best suits its operational and financial management needs. What is the accounting equation? The balance sheet is based on the accounting equation, a tool showing an accounting tool showing the resources of the business, which is the assets, and the claims on those resources, which is the liabilities and owner's equity. So this equation is assets equals liabilities plus owner's equity. This equation highlights that a company's assets are sourced from either borrowing, which is liabilities, or investments made by the owners, which is the owner's equity. In the balance sheet, the asset section must be equal to the combined liability and owner's equities section, ensuring a balance. This is why it's called a balance sheet. For an architectural firm in the Philippines, this principle remains the same, ensuring that the firm's financial position is accurately represented at a given point in time. So let's prepare two balance sheets for your hypothetical store. Katong the Archie model kit, diba, you remember? One for the first day you began operation and another for the end of your initial month in business. Imagine that upon starting your firm, you borrowed 10,000 for your parents and contributed 5,000 of your personal funds. Your initial balance sheet would clearly display 15,000 in cash as your assets. Of this amount, 10,000 is borrowed, your liabilities, and you're invested 5,000 of your own money or your owner's equity. So upon starting your business, this is not firm. So figure, as you can see at figure 1.6, the balance sheet number 1 for Archi model kits, your assets, which is in cash, because this business is based on cash basis accounting. So you have a cash of 15,000. Your liabilities plus owner's equity, um, you have a liability which you borrowed the money of amounting 10,000 from your parents, and you have your own savings. Uh, as the owner's equity, you invested your savings as the owner's equity of 5,000. So the total liabilities plus owner's equity is 15,000, equal to your assets. It should be balanced. Now, let's examine how the situation evolves at the month's end. Remember that your business earned 8,500 from selling 50 units during February from your income statement na siya, class. And you choose to reinvest these earnings. Ang 8,000, this 8,500 profit, both the company's assets, its cash, and your stake in it, its owner's equity. Your balance sheet on February 29 will reflect these changes. Once again, your balance sheet remains balanced. You now possess 23,500 in cash. This is your balance sheet. So 10,000 that you borrowed from your parents and 13,500 that you invested in your business. So your initial 15,000 investment plus no, your initial investment of 5,000. 5,000 investment plus 8,500 profit from this month, which you've retained in the business. So total of 13,500 from the owner's investment or owner's equity. So figure 1.7, balance sheet number 2 for RT model kits, ended March 29. So a month later. Your cash or your assets, you have a cash of 15,000, which is the original from the original investment, and plus the 8,500, a profit of the whole month operation, which is 23,500. So to balance the assets, you have liabilities plus owner's equity. Your liability is 10,000. Your owner's equity is 13,500. 5,000 from your savings and 8,500 from your profit. So your total liabilities and owner's equity is 23,500. So as I said, it should be balanced. The asset and your total liabilities and owner's equity. So accounting is valuable for even for small business. It indicates whether you made a profit by now. It allows you to explore hypothetical scenarios to estimate your profit under various assumptions and conditions. It helps you calculate the number of units required to break even or achieve a specific income goal. Lastly, it provides a clear picture of your assets and their resources. So the key takeaways for this topic, the 3 financial statements prepared by accountants are income statement, the balance sheet, and the statement of cash flows. And second, in preparing financial statements, accountants adhere to a uniform set of rules called Generally Accepted Accounting Principles, which is the GAAP. And um, the principles for financial reporting are established by independent agency called Financial Accounting Standards Board. The income statement shows what the firm's revenues and expenses and whether it is profitable or made a profit. So the balance sheet indicates what assets and liabilities the business has and the amount that its owners have invested in it, the owner's equity. And the statement of cash flow shows how much cash the business has coming in and it furnishes information about three categories of activities that cause cash either to come in or go out from operating activities, investing activities, and financing activities. So the break-even analysis is a technique used to determine the level of sales needed to break even, operate at a sales level at which you have neither profit or loss. And to break even, total sales revenue must exactly equal all expenses, both variable and fixed cost. And to calculate the break-even point in its units to be sold, you divide fixed cost by contribution margin per unit. The selling price per unit minus variable cost per unit. This technique can also be used to determine the level of sales needed to obtain a specific profit. So that's the balance sheet. Now, we will go to accrual accounting. The previous discussions about the RT model kit is, di ba, made from its cash basis gid ang tanan transactions. The money invested is based on cash and the payments is based on cash. So now we will learn about the accrual accounting. So our learning objective is to understand the difference between cash basis and accrual accounting. Now, let's go a step further by examining the world of accrual accounting. In our hypothetical example, we've assumed that all your transactions were made in cash. You paid cash for your inputs, your materials, and for your other expenses as well. Your customers paid in cash when they bought your Archimodel kits. In the real world, things are different, especially in construction and architectural practice. Remember that class. The following are some examples. Clients may not have always pay immediately. So, di ba, based on our professional practice, we give our clients 15 days to pay us the service rendered already. So they often engage services or order materials and settle the payments later. When this occurs, the firm has an account receivable. So it is the record of cash that will be received from a customer to whom a business has sold products on credit, meaning it is owed money and will receive it in the future. Firms usually don't pay cash upfront for materials, labor, or other expenses. They often pay this cost later. In this scenario, the firm has an account payable. Example, in a design and build practice, um, sign a credit term with supplier, and you would put that as account payable to your financial statement, to your income statement. So, what is account payable? It is a record of cash owed to sellers from whom a business has purchased products on credit, indicating it will make payments in the future. Construction and architectural firms often purchase produce materials and hold onto them for some time before using them in projects or selling them. This is known as inventory. So goods that a business has made brought or expects to sell in process of normal operations. You engage in a hardware store, hardware business, so you have inventory. You also call your materials as your inventory if you are engaged in a design and build business or construction business. So these firms invest in a long-term assets, also known as fixed assets, such as vehicles, office buildings, and equipments like backhoe or one bagger mixer, no, which they intend to use over an extended period, typically more than 1 year. But this equipment have end na siya. So end. So na depreciation that I will discuss later. So in situations such as this, firms use accrual accounting, a system in which accountant records a transaction when it occurs without waiting until cash is paid out or received. Here are some basic principles for accrual accounting. First, a sale is recognized on an income statement when it takes place, regardless of when payment is made. Second, an item manufactured for later sale or bought for resale becomes part of inventory and appears on the balance sheet until it's actually sold. At a point, it goes on the income statement under category cost of goods sold. Then fourth, a long-term asset that will be used for several years, for example, a vehicle, machine, or building, appears on balance sheet. Its cost is spread over its useful life, the number of years that will be used. Its annual allocated cost appears on the income statement as depreciation expense. The cost of the long-term or fixed asset spread over its useful life because equipments have will depreciate in time. It's easier to make sense of all this when you see some real numbers. So let's assume that you successfully operated the Archi Model Kit company when you were in college. Now, fast forward and you became an architect and you decide to set up your own architectural shop alongside with your design and build architectural firm because, 'di ba, we have to double our income or in architectural practice nowadays, we will not depend on our firm lang yun. So we have to have another source of income. So we decided to put up an architectural shop. During your 5 years in school, you noticed that there was no store near the campus, near Lapasan, no store specializing architecture supplies met the wide range of architecture students' specific needs. So that's the purpose of your proposed store to provide products that satisfy the specific needs for architectural students. Then you decided to call your store the Archi Shop. Your product line will range from things needed in drawings such as paper, pencil, ruler, triangle, T-square, triangular scales, etc. To things that are just plain fun and make architecture students' life more enjoyable such as gift packages, posters, lava lamps, games, inflatable furniture, bean bags, chairs, message board, shower radios, backpacks, and you also plan to sell the original Archi model kits. You'll advertise to students and parents through college newspaper and your own website. Okay? Sa tuwa kay wala naman newspaper or I think the Trailblazer. And maybe you could put that on the LED wall outside the school. That's a expense. So um you will create an accrual basis financial statements. So now let's repeat the process we went through with your first business, the Archi Model Kit. First, we'll prepare a beginning balance sheet that reflects your new company's assets, liabilities, and owner's equity on your first day of business, which is January 1st, 2026. Tama ba ko, class? architect na mo in January 1, 2026. That's 2 years from now. Maybe 2028. Anyway, next, we'll prepare an income statement. Then finally, we'll create a balance sheet that reflects the company's financial state at the end of your first year of business. Though the process should now be familiar, the details of our new statements will be more complex because your transactions will be more complicated. You're going to sell and buy stuff on credit because nana mo'y credit card. Maintain an inventory of goods to be sold. Retain assets for use over an extended period. Borrow money and pay interest on it. And deal with a variety of expenses that you didn't have before, such as rent, insurance, and so on. So let's go to the beginning balance. Your new beginning balance sheet contains the same items as the one you created for your RT Model 2 company. Cash, loans, owner's equity. But because you're already perform a broader range of transaction, you'll need some new categories. Like you bought furniture and equipment that you'll use over the next 5 years. You'll allocate the cost of these long-term assets by depreciating them. So, dili one time ang pag-deduct sa equipment. It should be spread out through 5 years. So, because you estimated that this furniture and equipment will have a useful life over 5 years, you allocate 1/5 of the cost per year for 5 years. And then you've purchased an inventory of goods for later resale, your stocks. And you've incurred two types of loans. One that's current because it's payable in 1 year, and one that's long term because it's due in 5 years. So nag-loan mo sa co-op, USDP co-op, or bank, video. So you need to prepare a more sophisticated balance sheet than one you created for your first business. We call this kind of balance sheet classified balance sheet. Balance sheet that totals assets and liabilities in separate categories, because it classifies assets and liabilities. So, assets on a classified balance sheet, assets are listed in order of liquidity. What's liquidity? It's how quickly they can be converted into cash. They're also broken down into two categories: the current assets, cash, and other assets that you intend to convert into cash within a year, and long-term assets, assets that you intend to hold for more than a year. Okay, your current assets will be cash and inventory, and your long-term assets will be future and equipment. Liabilities are grouped into similar manner. You have current liabilities that you'll pay off within the year. So if you have a loan within the year, that's under current liabilities. And if you have liabilities that don't become due for more than a year, let's say 5 years, that's under long-term liabilities. So you have two loans, one loan payable in a year, which is considered current, and one loan payable in 5 years. It's long term. So you've now prepared to examine your initial balance sheet as depicted in figure 1.8, balance sheet for Arki Shop. Once again, your balance sheet is balanced. It should be balanced. Ang asset is same with the liabilities plus owner's equity. Kaya kung dili na siya balance class, dili na siya balance sheet, ha? So remember that. So the total assets of 275,000 are matched by total liabilities and owner's equity of 275,000. We'll start our review with the liabilities and owner's equity section. Due to a compelling business plan, okay, maayo ka inyong business plan, you've secured a loan of 125,000 from a local bank, let's say BDO, or from USTP Co-op. So due to a comprising a short-term loan of 2,500,000 na dapat i-pay mo within the year, and a long-term loan which is 100,000, more than 5 years ang term, or 5 years ang loan niya na term. So the bank applies an interest rate of 8% per year, representing the cost of borrowing. Additionally, you've invested 150,000 of your own funds into the business because during your college years, katong mga na-income ninyo sa imong business nga RT model kit, you put it into sa MP2 and na-mature na siya after 5 years, or when you reach 25 years of age. Okay, maturity sa MP2 kay 5 years man. So I used MP2 nga as example nga an investment na institution, no, na where you can make your money grow. Okay, so this is figure 1.8, balance sheet for Arcade Shop. So month ended March 31 to 2029. So you have assets. Your current assets have cash of 50,000, and your inventory is 75,000. 75,000. So muna siya mga stocks nimo. And your long-term assets, your furniture, display, and equipment, 150,000. So in terms of liquidity, dili na nimo siya i-dispose within the year because that's a long-term assets. So ma-dispose lang na siya when you have padulong na mo sa bankruptcy. That's why mo na pamaligya ang mga furniture, mga equipment nimo. But if healthy ang company, that's under long-term assets. So you have a total assets of 275,000. And your liabilities and owner's equity, your current liabilities, because you have a loan payable in a year, within the year, you have 25,000. And long-term liabilities, loan payable due more than due in 5 years. In 5 years. So, and plus, your owner's equity, diba, you've invested 150,000 from EP2. So, when you total this out, it's 275,000 equal to your assets. Okay? So, now, let's concentrate on the assets section. What do you have to show for your 275,000 in liabilities and owner's equity? Of this amount, 50,000 is in cash in your checking, savings, and money market accounts. You use another 75,000 to purchase inventory that you sell throughout the year. Finally, you spent 150,000 on several long-term assets, including sign for your store, furniture, store displays, and computer equipment. You expect to use these assets for 5 years, at which point you probably replace them because it's outdated already. So that's the balance sheet for a more complicated setup on accrual accounting basis. So let's go to income statement, which is shown in figure 1.9, income statement for Archie Shop. It's more complex than the one you prepared for your Archie model kit company, and the amounts are much higher. In addition, the statement covers a full calendar year. This is the proposed income statement for Archie Shop. You have sales of 500,000. You less the cost of goods sold of 275,000. Your gross profit is 225,000. That's the gross profit. You less the operating expenses for your salary and employees' benefits amounting to 75,000. The depreciation of the equipments. You divide 150,000 into 5 years. You spread out the depreciation of amounting 30,000. You have rent and utilities of 20,000 and advertising 20,000, and other insurances like office expenses, so miscellaneous you have 30,000. Your total operating expenses is 175,000. Your operating income is the difference between the gross profit and your total operating expenses. You have operating income of 50,000. So that's a good sign because it's positive. So from the operating income, you deduct the interest expense from your loan, of 125,000, of the 8% interest of 225,000, just 10,000. So your net income before income taxes is 40,000. But you have to less the income taxes, which is 25% income before taxes because nag-file ka og sa BIR, di ba? The percentage tax, income tax, country tax. So you deduct that. So in this example, that's 10%. 10,000. 25% of the net income before income taxes. So that's 10,000. So your net income, you're left with 30,000. So imagine from 500,000 imo nga sales, 30,000 lang imo ang net income. So mo na siyang importante class na you have to study how to prepare income statement kay it seems nga dako kay mo sales 500,000 but wala nimo kung wala ka, if you did not prepare the income statement and you don't know how to prepare the income statement, you're not aware nga losing naman di ka or gamay ra kaayo ang imuhang income. Okay? So note that this statement is tailored for merchandising company. Merchandising, a business that earns profits by selling goods. How can you determine this? Business that provides services instead of merchandise, such as architectural firm, don't have cost of goods sold or COGS in line of their statements. Wala siya cost of goods sold. One niya is cost of service, or cost of making business. Wala cost of goods sold sa dili siya merchandising. Dili merchandising companies such as architectural firms. We replace it with cost of service. So the structure of this income statement emphasizes a crucial financial principle in running a merchandising company. You must sell goods at a profit known as a gross profit that is ample enough to cover your operating expenses, interest, and taxes. Your income statement reveals that you generated 225,000 in gross profit from the sale of goods. This amount is adequate to cover your operating expense, operating costs, interest, taxes, resulting to a net income of 30,000. A few additional expenses. Note that your income statement also lists few expenses that your first business didn't incur, such as depreciation expense. Wala man tayo depreciation expense sa katong cash basis accounting, sa inyohang RK model kit. Recall that you required some long-term assets such as store signs, displays, furniture, and equipment for a total amount of 150,000. By estimating that you'd use these assets for 5 years, your estimate of their useful lives, your income, you spread the cost of 150,000 over 5 years. Therefore, for each of these 5 years, your income statement will show 30,000 in depreciation expense. 150 divided by 5 years was 30,000. So what is interest expense? When you borrowed money from bank, you agreed to pay interest at an annual rate of 8%. Your interest expense is 10,000, which is derived from 125,000 times 8% times 0.08. So is a cost of financing your business and appears on your income statement after subheading operational income. So next is the income taxes. Your company must pay income taxes at a rate of 25% of net income before taxes. This amount of 10,000, which is 40,000 times 25%, appears on your income statement after the subheading net income before income taxes. It's subtracted from income before income taxes before you arrive at the bottom line or the net income. So let's see an end of the first year balance sheet. So from annual man ninyo, fiscal year or calendar year na financial statements. So let's say it ended December 31st. You have assets, your current assets, cash is 70,000. You have accounts receivable because your customer didn't pay you in cash. You have accounts receivable of 90,000. You have inventory of 80,000 because you have stocks na wala pa na baligya, no? So you have a total current assets 240,000. Your long-term assets, which is your furniture, your display, your equipment, amounting of 150,000. And you less the accumulated depreciation of 30,000. So you have a total long-term assets of 120,000. Your total assets now would be 360,000. You add the total current assets and your total assets, 360,000, amounted to 360,000. So your liabilities and owner's equity, current liabilities, because you have accounts payable of 80,000 because giutang ra nimo ang imong inventory na 80,000 dire. For example lang na ha, you have payable no sa imong supplier 80,000. So long-term liabilities, loan payable due in 4 years, you have 100,000 na. Kay medyo nabayad na nimo ang 50,000 itong, or let's say 100,000 na lang nabilin sa imong 125,000 na loan. So your owner's equity, you invested 150,000, right? Sa imo from the MP2 nimo nga fund. So i-add nimo ni karon ang 30,000 nimo nga net income nimo from the year nga gi-operate nimo ang Archishop. So the total of 180,000. So your total total liabilities and owner's equity is 360,000, equal to your assets. Okay? Okay, so first examine your assets. At the end of the year, you have a cash balance of 70,000, an inventory worth of 80,000. Additional, you have accounts receivable of 90,000. Because many of your customers have purchased goods on credit and will pay later, the balance sheet also represents two figures for long-term assets. The original cost, 150,000, and accumulated depreciation amount of 30,000. Accumulated depreciation indicates the amount charged as depreciation expense since the assets were acquired. The net value of the long-term assets is now 120,000 because 150,000 minus 30,000. which represents the difference between the original cost and the amount they depreciated. The total value of your assets is 360,000. The combined total of your liabilities, 180,000, and owner's equity, 180,000, also equals to 360,000. Your liabilities include a long-term loan of 100,000, now due in 4 years, and accounts payable, 80,000, money that you'll need to pay later purchase made credit. Your owner's equity, your investment in business totals 180,000. From 150,000 initially contributed plus 30,000 in earnings from the first year that you retain in business. Okay, so that's the balance sheet of the Archie model shop or the Archie shop. So the statement of cash flows, we now turn our attention to a type of financial statement that we haven't discussed yet. While the balance sheet and income statement provide valuable insights to owners, investors, and creditors, they each tell a different part of the story. The balance sheet shows the current assets of the company and their sources. The income statement, on the other hand, reports income on an accrual basis, recognizing revenues when earned and expenses as incurred, regardless of when cash transaction occur. However, the lifeblood of any business, its ability to generate cash to continue its operation. It's not uncommon to hear about companies facing cash flow issues. This problem might stem from various factors such as product not selling expected, excessive investment in an oversized facilities, sales to customers who are unable to pay, or simply overspending by management. Okay? So, yeah, overspending ng management nga imong magamit ang imuhang cash sa imuhang business sa imong personal nga expenses. So that's not a good practice. So later on you will run out of cash and dili na makamove ang imong business. No? Thus, owners and other stakeholders require financial statement that helps them understand the company's cash flow dynamics. So, kung dako na kay mong company, mangayo na dayon na ang mga stakeholders. So, asa man ang cash flow ani, unsa in and out sa money. Okay? So, the statement of cash flows tells you where your cash came from and where it went. It furnishes information about 3 categories of activities that causes cash either to come in, cash inflows, or go out, cash outflows. So we have from operating activities, we have from investing activities, and financing activities. So first, cash flows from operating activities come from a day-to-day operations of your mainline business. Kanag yung sa main yun ninyo sa nag-sell mo product, no? Kung unsa ang naging ana, so that's from operating activities. So second, cash flows from investing and activities results from buying or selling long-term assets. Like nagpalit mo og equipment nga instead nga ma-expense to siya kay garant mo og let's say bagger mixer. So now nag-invest mo og bagger mixer. Cash flows for investing activities result from buying or selling long-term assets. So that's include if you bought a bagger mixer, no, instead of naamoy expenses dito sa rent sa bagger mixer, wala na siya dito because nag-invest mo og sa long-term asset ninyo. Or maybe ang inyong earning inyong gi-invest sa stocks and then naada yung income ana. So that's investing activities. And the third is the cash flows from financing activities result from obtaining or paying back funds used to finance your business. So that's count as outflow kung nakay gibayad nga loan or mga financing activities o that's cash outflow. Okay? Figure 1.11, statement of cash flow for Archishop. Example, cash inflows from operating activities. You have 45,000, and cash outflows from financing activities because you paid a loan. So 25,000. So you have an increase of cash during the year of 20,000 because nag-gain man ka sa imong operating activities. Okay. So a cash flow statement for Archishop would resemble the one in figure 1.11, statement of cash flows for the Archishop. You generated 45,000 in cash from your company's operation, a cash inflow, and utilized 25,000 of this amount to repay your short-term loan. The net result was increased in 20,000. This 20,000 increase in cash aligns with the change in your cash over the year as reported in your balance sheets. You had an end of the year cash balance of 70,000 and the beginning of the year balance of 50,000. So when you deduct the 70,000 minus 50,000, you have 20,000. Okay, since you didn't buy or sell any long-term assets during the year, your cash flow statement shows no cash flows from investing activities. So you can see in this example. So what are the takeaways? Companies using cash basis accounting recognizes revenue as earned only when cash is received and recognize expenses as incurred only when cash is paid out. That's why it's called cash basis accounting. The cash basis method of accounting ignores accounts receivable. Wala na siya sa statement of account, no? Ang accounts receivable. Ang accounts payable pod wala sa to ang account income statement. So also the inventories and depreciation wala sa to ang balance sheet. In contrast, companies using accrual accounting recognizes revenues when they are earned regardless of when the cash is received, and expenses when they're incurred regardless of when the cash is paid out. Most companies use accrual accounting, including architectural firms. Okay? So, wala pa ko'y nadunggan nga architectural firm nga nag-use of cash basis accounting. So, I think that would be the end for this week, no? The topic for this week. So, I will give you an exercise, your course requirement for this week. So, it's a balance sheet and cash flow for a hypothetical architectural firm. This is the scenario. You are the owner of Art Design Studio, a newly established architectural firm. You started your business on January 1st, 2027 with an initial investment of 500,000 in cash. So during the first year of operation, you had the following financial transactions. You have a revenue from architectural services of 800,000. You have expenses of salaries, rent, utilities, etc. of 600,000. You purchase a office equipment such as computer, printer that total to 100,000, no? The expected useful years ani nga mga equipment is 5 years only. So you spread out the depreciation cost into 5 years. Payment of short-term loan is 50,000. The interest expense on loan is 5,000. Your cash received from a new short-term loan is 200,000. So you compute that class, ha? Mo ni siya ang tricky part na karon. Payment of short-term loan is 50,000. You have an interest expense on loan which is 5,000. Tanaw na nimo ang pila percentage ana. no, percentage. So cash received from a new short-term loan is 200,000. So assume a straight line depreciation method for the office equipment and no resale value at the end of its useful life. So your task is, first, you prepare a balance sheet for Archidesign Studio as of December 31, 2027, and you prepare a cash flow statement for the year end December 31st, 2027. Okay, so that's your assignment. And also, I would add, no, you have to, I will scan this so that you'll know how to bill, no, in the future. It's the title of the article is Getting Paid by Buji plus Royal Architect plus Design. So it's a 3-page article and you read it and make a reflection. So you write your assignment on a short bond paper and also your reflection for this article Getting Paid, so that you'll know that it's really accrual, no, accounting ang ato ang i-use when in terms of architectural practice nga business. Okay? So, I think that would be the end of my lecture. And next week, we will be having a short quiz about the oral gihapon ta first part, and then second part would be Google form. So, during your schedule, your class schedule, please be available because I will not accept reasons like walay stable nga internet um, or naay gitrabaho because this is an announced nga exam. Okay, you are still a student. You have responsibilities as student. Miskin na amoy mga side jobs. Every other week ra ko ga synchronous sa inyo, so make yourself available during your class schedule for the oral recitation or oral exam and your quiz, no? So busy kaya ako FB. Okay, sige class. So I hope that it's clear. Okay? So the deadline for this activity, for the exercise and the reflection would be this Friday. When is Friday is 22nd, no? As usual, walay limit sa time for as long as the office is open, you can submit. But if close na, so Saturday na ka, if makolek na nako, masapon na dahil nako kinsay late. Okay? Mag-ampo ka nga, dili pa nako makolek ang original. So, ma-include pa ka dito sa original when you submit on the Saturday. But kung ako nang makolek, so klaro na dahil kaayo nga late mo. Okay? There would be deductions on late submissions. Okay? Okay, class. So, that would be the end. So good luck everyone and see you next week.